Okay, hi everyone. We're back in action again. Last week, as you know, we didn't have a class because of Anzac Day, and unfortunately you were forced to go to someone else's class. Who went to another class last week instead of this one? Anyone? No? You all chose to boycott it, not go anywhere. Oh well, that's what happens. Sometimes the other times weren't convenient to people, you know, and that is just a fact of life. But you know, the official reason why they wouldn't let us have a replacement was it wasn't in the budget. Right? That was the official reason. Can you believe that? They said that it wasn't in the budget, so yeah, we can't run another class. So. Anyway, that's the way the cookie crumbles. All right, I've got the attendance. I'll circulate it, and you can tick your names off. So what we're going to do, first of all, we're going to actually do some past exam questions that would revise what we did last week, or what we could have done or should have done last week. So we've got 4 past exam questions that we'll go through, and hopefully if you can grasp those, then you'll get the gist of what was going on. But there is actually a recording there that you can listen to, and there's obviously the slides that you can go through. So let's have a look at these past exam questions. The first one here is asking us to compare the periodic and perpetual systems, right, in terms of a control device. Well, clearly, the perpetual system is a much better control device than the periodic, right? Because the perpetual system is giving you an updated amount of inventory at any point in time. So you can compare it to what you've got on hand, and that's where your control comes in. But with the periodic, you just got your physical count and then you adjust it. You don't really know whether you're losing inventory through theft or whatever. It all gets included in your purchases. So yeah, the perpetual is the one that does give you that control. The other thing that they ask you to do in this question is to enter those entries, the 4 of them there, for Thomson Traders during June, including your GST. All right, so we did talk about GST last time, but admittedly we're only looking at it from the accounts receivable and sales perspective. Last week it was gone into the cost of goods sold and looking at how it impacts on that. Right, so it says GST must be accounted for. Right, so let's, we'll just scroll down to the solution for that one. All right, so there's our spiel on the periodic and the perpetual, distinguishing between what they do. And the second part is where we do our analysis. So for the first entry, we had our inventory, which was 30,000. Obviously the GST is at 10%, so that's an additional 3,000. And the suppliers would be asking for $33,000. Then on the 8th of June, that amount was paid, less discount, because they allowed for a 2% discount, and that amount that was actually paid was only $32,340 after allowing for 2% discount. So the 2% discount worked out to be $660. Now, we don't put it all to revenue because part of it is relating to the GST. Because remember, the GST that we've booked here is on the basis that we're paying the full amount, all right? We're paying the full amount. But in fact, when we get a discount, we have to make an adjustment to our GST at 10%. So that's what we're doing here. We're adjusting our GST for that portion that we're getting back through the discount that we've claimed. So it works out to be $60, and $600 will be your discount revenue. On the 23rd, we made some sales, and the sales were for $26,000 plus GST of $2,600, and the total amount that was paid, or I should say that was collected or booked to our debtors, was $28,600. Now, of that amount, $16,000 related to inventory, so we need to adjust our cost of goods sold and our inventory counts accordingly. And then finally, on the 30th of June, the customer paid the amount outstanding. He paid his balance, and he was allowed discount. We gave him discount of 1%, and that amounted to $286, right? $286, and of course, we also have to adjust the GST on that as well. So 10% of the $260 is $26, so that was our GST adjustment. So the amount of cash that we would be receiving from our customer was $28,314. Right, is everyone okay with that? Yeah? All right, good. Right, let's go to the second one. So we'll go through each of these so that you've got the hang of it. The second one is looking at some transactions, again, using the perpetual inventory system. This time we've got a sales return and we've got purchase returns as well that we need to account for. But the same deal, we need to do the journal entries including GST. So let's go and see how that pans out. Go down to number 2. Right, here we go. So on the 2nd of June, we purchased some inventory, including the GST, which works out to be $1,080. The actual inventory that we acquired is $10,800, and the amount that we paid to the supplier will be $11,880. But then there was a return, right? There was a return of goods. So when the goods get returned 2 days later, because they were defective, we obviously are not going to pay for the goods that we're returning. So we return $800 worth of goods, plus GST of 10%. Thank you. And that means that we're giving them, or we've been given a credit for $880. So the amount that's outstanding now is $11,000 even. On the 5th, we make a sale, and the sale is for $17,000 plus GST of $1,700. So our customer is being billed for $18,700. The cost of that sale was $9,500. So we debit COGS and credit inventory because the inventory is going out. And then on the 7th, there was a sale return. So the customer didn't like something that we gave him, so he's returned the goods to us, and we need to adjust our sales. So we put it through sales returns by debiting that account, and the amount was $1,200 plus GST of $120. So the total amount that we're giving him a credit for and reducing his amount payable is by $1,320. Obviously, when the goods come back, we have to adjust our inventory account. So they're coming back into inventory. They were worth $600, so our inventory goes up by that amount, and our cost of goods sold is reduced by the $600. And then finally, we have a payment from our customer of $17,380, and we credit our accounts payable with that amount. Okay, let's go to question number 3. Question 3 is pretty much the same as the previous ones, right? Need to do the journal entries and account for GST. I'm just looking to see if there's anything different there. No, everything's much the same. You've got a few returns, you've got sales and purchases, and you need to account for them using the journal entries. Okay, so there's the solution for that one. And I think by this time you should be getting quite familiar with these entries, and they should be becoming second nature to you. So when you make a purchase, obviously we need to increase our inventory and increase our liability for the accounts payable, and we also need to take up the GST on that acquisition. And then when we have an adjustment, right, and the goods get returned, obviously the inventory needs to be reduced because some of the goods are going down, and the amount that we owe our supplier also needs to be reduced. And of course we adjust the GST. With the sales, same situation, increase our accounts receivable, increase our sales revenue, and include GST of 10% on it. Don't forget to account for your cost of sales. They need to be debited and the inventory credited for goods that are being sold. And on the 11th, we had sales returns. The account gets debited along with the GST, and we credit our accounts receivable. And of course, with each sale, we have to do an adjustment to our inventory and cost of sales. And then on the 15th, our customer paid us, but we gave him a discount. So he's taken off his discount, and that net amount that he paid is after discount. And we obviously need to debit the discount allowed, which is an expense, and we also need to adjust our GST to account for 10% of that discount. And then finally, when we paid our supplier, we took discount as well, and part of that discount also needs to be adjusted against the GST. Okay, so that one was pretty much the same as the other. Right, now this one's a little bit different. It's just laid out a bit different. All right, so what we've got here, we've got our opening inventory, we've got purchases, we've got sales, we've got closing inventory, and we've got operating expenses, which are for cash. But the other thing we've got there is markup, right? Why do we need to know the markup? What's the purpose of that? Any idea? Or is it important? Not sure? What does the markup mean? What does the word markup mean? All right, I'll tell you. What it means is that the goods that we're selling include our profit of 40% on cost. Okay, so we get the goods for X amount, we add 40% on, and then we sell them. All right, that's what it means. So that 40% is our profit margin. It's our profit margin that we are including in the selling price. So the reason why it is important is for our cost of goods sold. So in order to work out what was the price that we sold the goods for, we need to know either the amount of the cost of goods sold or the markup. In this case, they've given us the markup. So the markup is quite useful in working out how much we need to adjust our inventory and cost of goods sold by. Now, what does it require us to do? It requires us to enter these items as a single transaction. So even though these things probably occurred over a period of time, for simplicity, they're asking you to enter them just once for the month, preparing a journal entry and closing entries. But this time they're asking us to ignore the GST. All right? So it's important that you read the fine detail. It says ignore GST, so we don't include GST. If it says include GST, we include GST. So don't waste your time doing GST calculations if you don't have to. Read your questions carefully. All right, let's go to our solution for number 4. All right, so the first one is the acquisition of inventory or purchases of inventory, which was for $60,000. So we're debiting our inventory account and crediting the accounts payable. We were told that the sales were for $92,400. So that's simply debiting accounts receivable and crediting sales for that amount. Now, in order to work out the cost of goods sold, we have to divide that amount by 40%, and that means that our cost of goods sold was $66,000. Right? $66,000 or thereabouts. I think it's been rounded. Okay, it looks like it. It's been rounded, but anyway, for the intents and purposes, that's the way you work it out. You divide the figure here by 1.4, and that will give you your cost figure. All right, the next thing is to work out whether or not there was any adjustment for the inventory, because we have the closing value of inventory at $17,000. We have the opening value of inventory at $24,000. And we know that we made a purchase here of $60,000. So that means, and we sold 66. Right, so there's the adjustments for our inventory. So that means that we actually lost $1,000 worth of inventory because our theoretical amount doesn't equate to what was actually on hand when we did the count. Because it tells us when we did the count, we had 17,000. So that's what we've physically got, but the the equation is telling us that there was a different amount. So it works out that there was $1,000 of inventory missing. So we need to reduce our inventory by that amount and debit inventory expense or inventory loss. We also have to adjust for the operating expenses, which we paid for. So we debit them and credit our cash. And then the final thing that they asked us to do was to do the closing entries. So in order to do the closing entries, we need to write them off to the profit and loss. So our expenses get credited, the P&L gets debited, and for the sales, they get debited and the P&L credited. So the difference between those two is $14,400. So that is our profit, and that goes off to retained profits. Okay, now that's a little bit different to what we've been doing, but does everyone follow? Because sometimes the examiner might present the information in a different format. So you have to be able to work out what's required, even if it is set out a little bit differently, like this one. I think when this one was on the exam, people didn't handle it all that well, right? Because they weren't used to seeing it in that particular format. So just do a bit of practice and make sure you are familiar with all ways in which the information can be presented. All right, so I think we might now be ready to start the second part of inventory, which is part 2. So that's what we're going to talk about tonight. And tonight is basically focusing on different ways of accounting for cost. Last week it was about perpetual and physical inventory. And tonight it's about the different ways in which we can account for inventory using cost. 4 methods that we're going to highlight are the specific identification, FIFO, LIFO, and weighted average. And then later on, we will look at NRV, or net realisable value. One of the things that was mentioned in last week's lecture was a case study on Dick Smith. Now, Dick Smith created an electronics business back in the 1970s, and he sold that about 10 or more years later to another organisation, who then sold it to someone else, and then they sold it to someone else, and eventually the business collapsed back in 2015, I think. And the reason why it collapsed was due to basically bad management. All right, it had expanded considerably, but it was then managed incorrectly, and they had a lot of issues. Anyway, one of the issues was earnings manipulation, right? Earnings manipulation. They were manipulating their results through a inventory purchase strategy and opportunistic accounting treatment. So the purchase strategy that they were doing, if you read the information on the internet or some other source, you'll find that they were pushing a lot of their inventory through the channels to their distributors to try and generate sales. They were offering bulk discounts for people that purchase large amounts of inventory and then trying to offload them. One of the things that I remember when reading about this was one of the stores, and I can't remember which one it was, but they had like 15 months batteries, right? Little disposable batteries that you put in your torch and that. 15 months supply based on their current sales on hand. Now, why would you have so much? Because those batteries obviously have a use-by date, and to have so many on hand is just ludicrous. And that's what they did. That was just an example of one of the things that they overbought. They bought far too much of things like that because they were cheap, all right? They were offered them cheap, and they bought them through the suppliers, and then they created their own adventurous accounting treatment to deal with these issues. All right, so as it says there, Dick Smith excessively purchased products to obtain rebates. All right, as an example, in 2014, $70 million in one type of supplier rebates for this particular product, VS2014, resulted in net profit after tax of $42 million, which shows a heavy reliance on rebates to boost earnings. Now, these rebates were actually recognised as a reduction in the cost of sales, right? So they effectively incorrectly treated the rebate. Because when you get a rebate from a supplier, it's like a discount, right? So it should be recognised as revenue, not shown as a reduction in the cost of sales. So they were doing that to boost up their profit margins and show that they were more profitable than what they actually were. And they also not only did that, but they generated those rebates even before the stock was sold, right? Because they were getting the rebates before the stock was sold and recognising it as a reduction in the cost of sales, even though the stock hadn't been sold. And as it says there, that's in contravention of the accounting standards. Clearly not allowed. So another thing that they did was with their loyalty cards, right? They had these, like Bunnings and all those other stores, these loyalty cards, gift cards and stuff like that. They were flogging those up to Christmas and just after Christmas, knowing full well the store was going to close on the 6th of January of 2015. And how could you look a customer in the eye and sell him a gift card for $100 or whatever it might be, knowing that he's only got 6 days to use it before the store's going to close and they're going to be useless? Because that's what happened. When the store closed, they didn't tell people that. They just said, we're not going to honour any of those cards. They're useless. You've lost your money. Sorry. So they collected the money for Christmas period, and then basically it was a donation to their coffers, because that is very unethical in my view. All right, what else did they do? They had obsolete stocks, obviously by over-purchasing. Many of their stocks needed to be written down, but they weren't written down, or they weren't written down sufficiently enough. And we're going to be talking about that later tonight, because the accounting standards require you to write down your inventory that is on hand to the lower of cost and net realisable value, which means the value that you can realise for that inventory in a sale. So with the fire sales that eventually occurred, as you can see a diagram here in this picture here, everything must go. Stock discounted 40%, right? And I think as closer to the date when they actually closed their doors, it discounted even more. So they had fire sales and they were selling things well below cost just to get rid of it. So they had a big cash flow problem, and as we know, the business failed. The share price declined, they had a lower profit, and eventually they folded. They breached their debt covenant. Do you all know what a debt covenant is? No? Okay, well, they had a loan, right, with the bank, and when the bank gives you a loan, particularly a business, they won't give you a loan without any conditions. Usually the conditions are part of the agreement, and that's called the debt covenant. So the condition might be that your liquidity ratio is above 1.5, or it might be that your cash flow ratio is greater than 75% or whatever. So they'll have certain conditions in that contract, and they breached many of those conditions, which potentially left them vulnerable to their bankers, who then said, well, you guys are not in a position to be able to pay this back, so we're going to foreclose on you and call in our debt, and that's what they did. Okay, so that's a bit of a real-life example of what happened to Dick Smith. Let's now talk about the topic from a theoretical perspective, and these are the things that we're going to deal with tonight. As we said, different types of cost flow assumptions, and we're going to see how it affects your profit and your inventory valuation, and then later on that should be cost, not cast. We're going to apply the lower of cost and net realisable value, just like what Dick Smith should have done with their inventory, and how that is important to managers in their decision making. All right, so when inventory purchases are made during the period, obviously the price of inventory is going to vary, it's going to change. Usually it goes up when you're acquiring inventory because of inflation, but sometimes you might be lucky and it goes down when you get a discount or it's on sale or something like that. The other thing that affects your inventory if you're buying from overseas is the exchange rate. If you're buying goods from overseas, the exchange rate will fluctuate, and that can affect the price that you pay. Also, if you buy things in bulk, like Dick Smith did, that can lead to discounts or rebates and lower your price. Now, the other thing that we often have an issue with is when we account for our inventory, it all gets lumped together. So effectively, we don't know what inventory we actually physically purchased on this day and what we purchased on that day and so forth. They all just get piled. If it's all the same, it gets piled into one big heap in the warehouse. So consequently, items with different costs get mixed together. So effectively, we can't physically determine which inventory we bought at what date and how much we paid for it, but we can keep an eye on it in terms of the costs through perpetual recording. So we can know that we purchased 100 units on this day and that's what we paid, and then another 100 on another day and we paid that much. So that is our best way of accounting for the inventory, using different prices. However, it doesn't solve our problem, because we need to work out how much of that inventory is going to be included in the closing inventory account and how much is going into the cost of goods sold. We know how many units we've sold and we know how many units we've got on hand, but at what price? What is the inventory that we've actually got? Was it the inventory we purchased at the start or in the middle or at the end? How do we do that? So in order to work that out, we have to make assumptions. And the assumptions will be one of those ones that we looked at before. You can use FIFO or LIFO or weighted average or specific identification in order to arrive at a cost of goods sold and a inventory on hand. Let's now have a look at an example. So the example we've got here is XYZ had 1,500 shirts on hand at the 1st of July 2015. The shirts cost $8 a piece, and throughout the year they purchased their shirts at different prices. $13 on the 22nd of August, $10 on the 19th, $12 on the 28th of January, $15 on the 12th of March, and then $13 again on the 8th of June. So you can see the prices are jumping all over the place, and it's going to be very difficult if the shirts are identical to tell which shirts were at what price and so forth. So we have to, as I said, make some assumptions. The physical count revealed that at the end of the period we actually had 3,500 shirts on hand. So there's our movement of shirts. We started with 1,500 and we acquired all of those along the way, and we ended up with 3,500. So if we ended up with 3,500, how much did we actually sell? Well, the answer to that would be to take the 15, add all these up, and then subtract our 35, and that would give us how much we sold, and it works out to be $56,000. So we sold $56,000, sorry, not 56, 56,000 units or 56,000 shirts. But at how much? That's the tricky part. So we have to split our costs between opening inventory and purchases, and obviously divide them because that's going to impact on our net profit and our inventory on hand in the balance sheet. So the methods that we can use according to the accounting standard is specific identification, FIFO, and weighted average. There is another method called LIFO, or last in, first out, but that method is not permitted in Australia. It is used in America, but not here. And each of these methods can be applied using either the perpetual or the periodic method. Okay, so let's go through them and see what differences they have and how they affect the profit. So firstly, we have specific identification. So this is where we track each individual item through the flow of inventory, and the key advantage of this method is that it's very accurate. Very accurate because we can track every individual item physically as it flows through the system. Obviously we can't use this with the shirts because we've got thousands of them. We're not going to be able to track every single shirt. But we can use it for other things. What other goods do you think this method could be more suitable to? Any idea? High value items, all right? Items that you don't have many of. For example, a car, right? If you're buying a new car each car is unique. They'll have different features, they'll have different bells and whistles that are there, and they'll be priced differently. So car dealers use this method in the valuation of their inventory, because they can track the car through their engine number and through their registration number, and they know exactly what features they've got, and so it works perfectly for them. Another one that it's often used for is a jeweller, with his rings and bands and all other types of goods that he sells. Again, because he doesn't have large quantities of things, he has a lot of different things, but they're all a one-off or not having a lot of multiple of the same item. He just has a few, and they're usually high value. So the specific identification is implying the use of the perpetual method. It's not suitable for periodic. It works better if you have a barcode, right, or some other way of scanning the item. That makes it much easier to apply. So it can be identified by a serial number or a specific purchase, but it can also be very time consuming and expensive if you're using it for a lot of small items, and that's why it's not applicable. And as we said there, it's for high value items such as motor vehicles, jewellery we talked about, and houses is another one that it's often used by real estate agents. Right, the next one is first in, first out, or FIFO as we like to call it. So this one assumes that the first units we purchase are going to be the first ones that we sell. So it's approximating the physical flow based on that assumption, and that assumption is probably realistic for a supermarket, all right? Particularly with perishable items, because you'll find that, we'll just use the milk as an example, they will push the ones with the use-by date that is closer to now to the front, and the ones that are coming in for that day, they go to the back, all right? So they have a turnover, and that works pretty well for them, so they don't have any obsolete stock on hand. So effectively, the ending inventory is going to consist of the more recently acquired units. So as it says, it's useful for perishable foods, right? So, or those that are subject to obsolescence. As I said, mainly milk and dairy things, bread, those sort of things. Not so much the canned foods, because they have a longer shelf life. Some of them can last for 12 months easily. So they're probably not as applicable. Another one is technology, right? We often see changes in technology. What's an item that becomes very quickly obsolete, that is a high-tech item? You've got two of them on your desk there, right? What are they? Phone and the computer, yeah, correct. Both of those change quickly. There's always a new model coming out or a new thing, and I was reading the other day that the suppliers deliberately slow down the phones so that they become slow, and you're thinking, oh, this old phone is driving me crazy, I'm going to have to get another one, right? And I did the same. I bought a new one the other day. It's only a couple of days old, right? iPhone 10. But that's their trick, right? That's their trick. They want to have you buy something new and changing your product all the time. So what happens under this method? Well, in times of rising prices, you're going to have a lower cost of goods sold, a higher profit, and a higher closing inventory because you're going to sell those low-cost items first, or at least that's the assumption. And your closing inventory is going to be based on more recent items, so that's going to be more expensive, and that will end up in your balance sheet. All right, we're going to talk about LIFO, or last in, first out, but don't get too excited about it because it's not used in Australia. It is used in some European countries. I think it's used in Germany and maybe a couple of other countries. Oh, it is used in America, as I said before, but not in Australia. So you only may encounter it if you're doing some work with an overseas company. But we'll go through the theoretics of it. It assumes that the last units purchased are the first ones sold. Right? It's a pretty big assumption, but it happens sometimes. Right? Sometimes things just get put on top of one another and the first ones go out, and then the ones that have been there for a year or two just stay there and may not get sold at all. Right? So it does create a low profit, and that's the reason why it wasn't permitted for tax purposes, because it understates your profit. And the ending inventory is also going to be understated because it's going to consist of the earliest acquired units. So it says there that it's used for things that have no use-by date, such as car parts or machinery parts that people might still buy them 10 years later for old models, and that's fine. They just sit there until they're actually sold. Or things that have a long shelf life, like petroleum. All right? I think I've got some petrol in a can in my garage that I've had there for 20 years. All right? And I used some on the lawnmower the other day, and it worked brilliantly. All right? So it hadn't gone off. It was still okay. I thought, I hesitated at first. I think, will I stuff up my lawnmower? No, it worked beautifully. So petroleum can last for a long, long time. I don't know what the shelf life's supposed to be, but if it's good, it can last. Metals, right? Things like copper and gold and silver and those sort of things, they obviously don't have a shelf life, and certain chemicals. Another one that I thought of that we could add to the list there would be sand, right? If you're buying sand for mixing up cement, right? I went to the garden supplier the other day. I wanted to put in some posts, and I bought a load of sand, and he just took it from the top. And I'm thinking, okay, every time he gets that sand, he's always going to take from the top. So that's the last sand that went in there, and it's the first one that comes off. So that's another example of goods that don't have a use-by date, because sand doesn't perish either. So generally, with this assumption, you're going to find that you're going to have a higher cost of goods sold, lower profit, and a lower closing inventory. But it does result in an inventory balance that is recorded at old prices and tends to be a bit outdated. And as we said, it's not permitted under the IFRS. All right, the fourth and final method we're going to address is the weighted average. And this one is the most complicated. So you need to concentrate when we talk about this one. It does average the items each time you make a purchase. So every time you're purchasing new items, you'll have to readjust the amount to take that into consideration. And the way in which we do that, we use this formula. We take the total cost of goods available for sale, which is your purchases plus the inventory that you had on hand, and divide it by the number of units available for sale, the quantity. and that will become the new weighted average amount. So your COGS and your inventory on hand are costed at this average cost, and we use the perpetual method, and it can also be called the moving average method. That's another name that's often referred to. So as I said, we recalculate the average price after each purchase. Does require a lot of calculation, but there's less profit manipulation with it. It's appropriate for goods that are homogeneous. That is all the same and tend to be mixed together. So it could be good for bricks, if you can see there in the diagram there, or maybe nuts and bolts or screws or things like that, that we have a lot of, and they're identical. All right, let's now put this into an example. So the example we're using is the shirts. If you recollect the original slide, I don't know what number it was, it might have been slide 3, where it told us the purchases and sales of the shirts, and we're going to apply various methods to calculate the cost of our goods sold. All right, so with an opening balance of 1,500 units and a unit cost of 8, the total cost of our inventory of shirts on the 1st of July was $12,000. And then we made various purchases along the way. And then we sold some on the 30th of November. Again, we had some more purchases for the next few months. And then towards the end of the year, we made another sale. So we can see in terms of our units, 59,500 units were available for sale. 56,000 were actually sold because we had 3,500 left on hand. Right, so we're going to use this basic information about the shirts to calculate our COGS and ending inventory with each method. So let's start with our FIFO method. Right, so with FIFO we start off with $12,000. We then have our purchase, the first purchase, which we record in there. So we had another 10,000 at 13. So we add that to our opening balance. So now we've got 11,000 items of shirts, and the total value will be 142,000. The original 12 plus the 130 from over here. Then on the 19th of October, we made another purchase, 19,000 at 10, which is worth 190. So that then gets added to our balance on hand. And we've now got $332,000 worth of inventory. On the 30th of November, we sold some items, in fact 25,000 worth. So under this method, we assume the earliest ones are the ones that went out. So that would be the inventory we had on hand, plus the next purchase, plus the one after, and then some of this one. Okay, so we've got 1,500 and 10,000, that's 11,500, and 13.5 makes the 25. All right, so that's the balance. So there's still 5,500 of this one left over at 10,000. So the inventory balance at that point is 55,000. Then on the 28th of January, we make some more purchases. So they then get added to the 5,500 we had up here. We had another purchase in March. Again, they get added in. And finally, another one in June. So they get added in as well. So that's our new balance of inventory on hand. And then we sold 5,500 plus 8,000 plus another 15 plus 2.5 at 13 to make up the total of 31,000 units. That was our sale on the 20th of June. So they're the amounts that we paid for those items as per our purchases. And therefore we've got $3,500 worth of 3,500 shirts left. And it's going to be at the last price, which was 13. So the closing inventory will be $45,500. To work out our cost of goods sold, we simply add up all of these items here, and that's in the wrong column there. It should be in this column here. It is 685,500, and our closing inventory is obviously this one here. Right, does everyone follow that? Right, because sometimes you're asked to do one of these in the exam as well. So to summarise, we had opening inventory of 1,500, purchases of 58, which amounted to 719, which gives us a total of 731. Ending inventory of 3,500, which was valued at 45,500. That comes off. So our cost of goods sold are 685,500. All right, let's now look at the last in, first out. Last in, first out. Same thing. We start off with our opening inventory of 12,000. We record our purchases in there, so they all get recorded there. So far, it's no different. It only becomes different when we deal with our COGS. Because when we come to selling 25,000, we start off at the other end. We start off with the 19,000 first and then work backwards. So we will then take 6,000 off the 10, and what we'll have left is 4 of these plus the original 1,500. So our inventory on hand now is only 64,000 because we're using the earlier purchases. And then we make some more purchases and they get included in our inventory balance. So that's the value of our inventory on hand before our final sale. And our final sale was for 31,000, so it works backwards again. Takes off the 6, plus the 15, that adds up to 21, plus the next 8, which is 29, and then 2 of this 4. And that means that we've got 2,000 at 13 and 1,500 at 8. So our inventory on hand is going to be 38,000, and if we add up all of these, it would come to 693,000. So to summarise again, there's our goods available for sale, ending inventory, based on the assumption of last in, first out, comes to 38,000. The cost of goods sold works out to be 693. Right, the last one is the weighted average. So the weighted average, under the periodic method, we can take the The total amount of 731 and divided by the units that we've got available, which will give us $12.28. So we can then apply that to our goods that we sold, which was 56,000, giving us 688. And our ending inventory will use the same number, and that will result in an ending inventory of 43,000. Using the perpetual method, we calculate it after each purchase. So for the first purchase here, we've got 130,000 plus 12 gives us 142, and we divide that by 11.5, and that'll give us $12.35, rounding it to the nearest cent. Then with our next purchase, we do exactly the same, adding 190,000 to that, and that gives us 30,500, and we divide that into that to give us $10.88. So when we have the sale on the 30th of November, we cost those 25,000 at $10.88, which works out to be 272,131. And that means then that we've got 5,500 of these guys left at $10.88, which works out to be 59,868. Then of course we've got some more purchases, 96,000 worth. So adding that to that, you get 155. So we've got $13,500 units. Divide that into that, and that gives us our cost of $11.55. We made some more purchases of 225, so we add that to that, which gives us 380. 15 and 13.5 gives us 28.5. Divide that into that. Means the price has gone up to $13.36. And then finally, another 6 at 13. 78,000 added to that gives us 458. And another 6 on that is 34.5. So the per unit price is averaged at $13.30. So that is the sale when we make that sale on the 20th of June. And that works out to 412,000. So therefore we've got 3,500 left at $13.30, which means that it works out at 46,552 to the nearest dollar. And our cost of goods sold adds up to 684,448. So let's compare the different methods. So what we can see from the three methods that we examined, our sales are going to be the same, right? It doesn't matter whether we're using perpetual or periodic, the sales will be identical under each method. Where it becomes different is in the cost of goods sold, right? So you can see that, as we said in the theory, LIFO has a higher cost of goods sold, which we've proven to be correct, and the moving average will be either in the middle or above or below, depending on the movements, all right? So the movements can be up or down. In this case, we had a combination of both. So our gross profit works out to be 434 under FIFO, 435 under moving average, and 427. It's the lowest under LIFO. Our expenses were 90. Our net profit, therefore, is those numbers, and our closing inventory was those figures. So you can see that for the periodic method, it's the same under FIFO and LIFO. It's only really different under weighted average, and it's not significantly different. It's only a little bit different. You can see there's just a few $1,000s difference due to the fact that this one is averaging them all at the end, and the other one is averaging them as you go along. So in summary, we can say that our FIFO method's going to result in the highest ending inventory, the highest gross profit, highest net profit and lowest COGS. LIFO, the exact opposite, and weighted average will generally fall somewhere in between those two. All right, there's a student task for you guys to tackle. All right, so I want you to have a crack at this one. All right, you're going to use the FIFO system and you're going to use GST. All right, we're going to have GST inclusive in some items. All right, you can see there. All right, GST is included. All right, so we need to make adjustments for that. Okay, so we need you to do the general journal entries, the income statement, and then we're going to do the weighted average method and do the general journals for that also. All right, I'll give you about 20 minutes to do that. It's about 6:10 now, so let's say about 6:30 we'll come and see how you're going, all right? Did anyone not sign the attendance? All right, a few people came a bit late, so keep your names off, please. Thank you. right, just a few more minutes, folks, and then we'll go through the 4 requirements. Okay, let's see how you fared. Starting off with the periodic journals, we recorded our purchases, 48,000, and the GST obviously is 10%. So that's 44,800, and the amount that we owe is 52,800. For the sales, it's 140,000 plus GST of 14, means the amount that we're expecting to collect is 154,000. Some more purchases on the 10th, plus GST, gives us an amount owing to suppliers of 79,200. On the 14th, we made some more sales. So the sales were for 68,000. GST obviously is 6,800 on that. So the total amount that's due is 74,800. Further sale on the 20th of June. Sorry, this was the collection of this. No, it's a further sale, sorry, that's what it is. Further sale of 66,000 plus GST, and that gives us another amount owing of 72,600. And then on the 28th, we had our purchase of 75,000 plus GST, meaning that we owed $82,500. And then on the 30th of June, we look at our opening inventory, which we know was 300 at $200, which works out to be 60,000. Our purchases, which we've just calculated, comes to 195. So both of those amounts go into our P&L summary, which add up to 255,000. We had sales of 274, and we had inventory on hand of 110,640. So our P&L summary gets adjusted by 384,640. So therefore, when we do our income statement, we just put all those numbers into it, and our profit works out to be 129,640. All right, part C is the moving average or weighted average. So we start off with our opening balance of 300 tables at $200, which is 60 grand. We then had some purchases on the 1st of June, which amount to 48,000. So they get added to the balance there. And we now have 500 items on hand. We divide that into 108, and it gives us 216 per item. So when we sell some on the 9th of June, that's the value that we attribute to them. 350 of them, in fact, 75,600. So that would leave us with 150,000 on that day at 216 each, and that's worth 32,400. On the 10th, we had another purchase at $180. So adding that to that, we get 104,400. And adding the 400 to the 150, we get 550. So that averages out to almost $190, which becomes our next unit price for the sale on the 14th of June. And that leaves us with 350 items on hand at that time, at that amount. So our inventory at that time is 66,437. We then sold some more on the 20th of June, so they go out at that price as well. So we've now got 200 left at that price, which works out to be 37,964. On the 28th, we purchased some more items, 250 at $300, which is 75. Add that to the 37, gives us 112. We add the 250 to the 200 and we get 450, divide that into there, and that gives us an amount of $251 approximately. But we had 448 tables on hand when we did our count, so obviously 2 tables went missing. So that's the value of our inventory, so we have to do an adjustment for the stock loss at that amount. So the stock loss works out to be $502. And our cost of goods sold, we can add up those amounts. It works out to be 142,539. And our closing inventory will be the 112. The last part is to work out the weighted average journals. So for the first part, the 1st of June is the acquisition of the inventory. That's the same. Likewise with the 9th of June, exactly the same as we had before. And then we've got our cost of goods sold. All right, so our cost of goods sold is based on the weighted average amount per our table. And that changes when we have another purchase on the 10th of June. On the 14th, we have another sale. And we have to include the cost of goods sold of that sale, again from the table. And the inventory is the other part of the equation. On the 20th of June, we have some more sales with GST, and the cost of goods sold we'll gather from the table that we created. And on the 28th, we had some more purchases, which we've recorded there. And finally, we record the stock shortage of $502. So our income statement is going to show sales of $274,000, a cost of goods sold of $142 and $37, which gives us a gross profit of $131,963. Less our inventory shortage means that our adjusted gross profit is $131,460 approximately. Okay, did anyone get that 100% correct? No? You all made at least one mistake. Okay, well, we'll have a short break now. So it's 6:40, so let's say 10 minutes adjournment to go to the toilet or do what you need, and we'll come back at 10 to 7. Yes, mate. No, you don't. So you.
So we can do anything. I'm going through all the topics again. So I don't have time.
No, you. Which topic is this? The one for the day? Oh, the earlier ones. If you weren't here, so you missed them. You mean you didn't come to the class? Oh, you didn't get them quick enough, right? I'll talk to the unit chair. All right. I'll talk to Ali. His name is. And see what I can do for you. I think he deliberately does that to encourage you to come to class, all right? Because in the past he's...
What we can do is we can practice other...
Yeah. I think so. I think I'll explain to him what's happened, and I'll see... Yeah, of course. Some people have, I noticed, been taking pictures of it.
I do, means I have 70%, but 30%.
Yeah, you've missed some of them. All right, that's fine. I'll have a talk to him and see what he can do for you, all right? Yep, I'll see what he does, all right? Hopefully he can give you a some sort of substitute, all right? Okay, let's continue. So we got up to the next thing that we need to look at is the lower of cost or market rule. Now for this one, we need to go to the accounting standard. And the relevant accounting standard is AASB 102 or the international standard IAS number 2. And what it says is that the inventory needs to be measured at the lower of cost and net realisable value. And the reason for that is because of conservatism. We can't have any assets, for that matter, overstated. So we need to reduce our inventory, among other items in the balance sheet, to their net realisable value, or a value that we can realistically sell it for. So effectively the definition that we use for NRV, or net realisable value, is the estimated selling price in the ordinary course of business. Now it's not a fire sale, it's not a special sale, it's the ordinary sale. What they are estimated to sell it for, less any costs of selling that or completing the sale. So that might include advertising or delivery and any costs of completion. And that is our net realisable value definition. Now often it approximates the market value, so consequently we often use market value instead of net realisable value. Now when it's less than cost, we need to write down the value in the financial statements to NRV because we can't have it overstated. And some of the reasons why it is less than cost could be obsolescence. In other words, the inventory is stale or it's almost at its use-by date. And a good example of that is perishables. I'll give you a practical example. Last Christmas, I was a bit lazy. I was having the family over for Christmas dinner and I hadn't made my brandy custard, right? So I rushed out to the supermarket on Christmas Eve at about 11 o'clock at night. The shop shut at 12 and I purchased a couple of cartons of brandy custard. To my amazement, do you know how much I paid for each litre of brandy custard? Have a guess. How much do you think I paid? The normal retail price was, I think, about $3 a litre. How much do you reckon I paid on Christmas Eve with about an hour to go before they were shutting the shop and there was little likelihood of selling it in a few days' time because the use-by date, I think, was the 26th of December. How much do you reckon I paid? $1? No, a lot less than that. 5 cents. 5 cents, can you imagine? So I got 2 cartons for 10 cents and I thought, oh, this is good. By leaving it to the last minute, I actually saved a bit of money. And it was perfectly okay. There was no problem. Everyone enjoyed it and said, oh, this is marvellous. I didn't tell them how much it cost. But that's the sort of thing that happened. So obviously that was a lot less than what they'd paid for it. The other thing that's also subject to obsolescence is technology. So computers, phones, anything, motor vehicles, things that have technology are very highly subject to write-downs. Another thing that you can often get cheaper if there's a scratch and dent sale. I don't know if you recall, before Christmas we had a massive hailstorm, right? I live out in the eastern suburbs. It wasn't so bad in Burwood, but it was really bad in Doncaster and Templestowe where I live. The hailstorms were the size of golf balls, right? And they were pelting down on people's vehicles, and so a lot of vehicles were written off, and many of the car dealers were selling because they had their vehicles out in the open and weren't undercover, and they're still selling hail damaged vehicles for about half the price, because the hail damage is enormous. I didn't realise how much it costs to fix just one dent. They reckon about $100 for each dent, and some of them had hundreds of dents in it, right? So that's why their price went down significantly to a scrap value. So you'll see that with motor vehicles. You might even see it with white goods. If they get damaged in the store and they've got a scratch on them or a dent in them, they will be discounted significantly, and it's often below the cost, depending on the amount of damage, of course. Another item that often gets discounted significantly is fashion items, right? Clothes, shoes, because those things go in and out of fashion, and retailers like Myers and David Jones, they don't want to carry summer season clothes, winter season, and everything in between in their store. They just haven't got the room. So they will discount to get rid of the previous season's stock. So they have a sale Boxing Day, and then they have another one at the half year. So that is where they discount their stock, often below cost, because of seasonality reasons and fashion. All right, so we said that it's related to the principle of conservatism, and if there's any write-down, then we need to expense it in the accounting period in which it occurs. So that's what it says in the accounting standard. And so the journal entry is to debit inventory expense and credit your inventory on hand. The other important thing that we need to do with the write-down is to apply it on an item-by-item basis. So we don't look at the total inventory and work out what the cost is and then do the same at NRV. We work it out on an item-by-item basis and then look at it after we've added it all up. It's also not by classification or by industry or by geographical segment. It's by item. So there are some theoretical arguments associated with this lower of cost or market rule. Arguments 4 is that historical cost loses its relevance anyway over time, because, as we know, prices of things go up, and the lower of cost or market value rule allows for a better matching of costs and revenues. So it's a more useful measure to apply for periodic profit. And we also note that inventory should not be stated at an amount greater than NRV, particularly if their selling price has declined or they're damaged or if they've become obsolete. So they're the key arguments in favour. The arguments against come to consistency, right? People might say, well, we're valuing these items at cost, this at NRV and something else at a different value. So we're not being consistent throughout all our items in the financial statements. And that's the main argument that is often presented. But we're not permitted to value our inventory upwards, right? Unless there's a reversal of a previous write-down. The accounting standard doesn't permit us to do that. And the other argument that's presented against NRV is that it's subjective. What is the estimated selling price? Now, sometimes we can get the estimated selling price by looking at the sales figures subsequent to year end. So let's say we're looking at a motor vehicle at the end of the year and the cost was $20,000. The estimated selling price is, let's say, $18,000. So how do we know that that estimated selling price is what we're going to get for it? Well, we don't. But if that car was sold before we finalise our accounts, we can find out what the actual selling price was and then compare it to that. So sometimes with hindsight, we can work out our NRV. If goods have been sold subsequent to year end, before you finalise the accounts, particularly for obsolete items and retail fashion items that might be on hand at year end, but they get sold in July or August, then you can look at what they were sold for and write them down accordingly. So let's have a look at this exercise that we've got here. So we're going to apply the lower of cost and NRV to these stock items. Let's assume we've only got 4 items on hand. Items 675, 732, 957 and 977. And we've got 5, 10, 15 and 8 on hand respectively at a unit cost of 50, 40, 55 and 10. That adds up to a total of $1,555 by multiplying all of those across and then adding them down. All right, our market price is as follows. Right, for the first item, it's $45, the second $48, $30 and $15. So that's our total market price, which comes to $1,275. Now, we don't take the lower of that and that, right? We said we do it on an item by item basis. So let's look at them individually. So the first item we have here, the market price is below the cost, so we apply market. So that's the figure we're going to use. The second item, 40 there, 48 here. So it's above the cost. So we use the cost. So we take this 400. For the third item, it's 55 versus 30. So clearly this time we use $30. So that will be 450. And for the last item, the cost is only 10, but the market price is 15. So we use the cost for that one. So after assessing the lower of cost or market rule, we find that the total value of our inventory should be $1,155. So what I'll get you people to do, and it should only take you a few minutes, is to do the journal entry to record the difference between the lower in cost or applying the lower of cost and market rule at the end of the financial year in this illustration. give you a few more minutes. The accounts to debit and credit are very easy because we had them in the previous slide. So you know what accounts you're going to debit and credit. It's just a matter of working out how much. All right, so what we need to do is to work out the accounts we're going to debit and credit. And I said we told you that from the previous slide. Yeah, all right. There's the entry there. Debit inventory write down, credit inventory. All right, so we gave you the entry. That's the accounts we're debiting and crediting. All you need to do is to work out the amount. And as you can see, the amount is 400. So it's this figure here. That's what the inventory is costed at. And that's the lower of cost or market value. So it works out to be exactly $400. Okay, good. All right, here's another exercise that I'd like you to do. And you need to do the journal entry. So you need to do the whole thing here. Alice sells 4 types of guitars. Cost and NRV at the 30th of June are as follows. All right, and you've got the quantities there. So what you need to do is to multiply them out and work out which one is the lower of cost and net realisable value. Add them up and then do your journal entry based on the difference between that and the cost. Okay, I'll give you about 10 minutes to do that one. just a couple more minutes. I think we should be almost there. Okay, let's go through the answer. So when we've got this information, obviously we need to work out our costs. So it's a matter of multiplying the quantity by the per unit price, and that'll give us the current value of the inventory. And then we can look at the NRV and the cost price and work out which one is the lower. So in the first item, G1, clearly the cost price is lower than the NRV, so we're going to use cost. For G2, it's the other way around. The NRV is lower than the cost, so we're going to apply the NRV. For G3, the NRV is lower than the cost, so again we'll apply NRV. And for the last one, G4, the NRV is lower than the cost per unit, so again we'll apply the NRV. So doing that, we add up our amounts for the NRV, compare it to the cost, take away the difference, and that is the amount of our write-down. So there's the total amount for the cost. It comes to 102,326. And applying the lower of cost and NRV rule, we find that the amount is 84,154. So we look at the difference between those two, which is around 18,000. And that's the amount of our write-down expense. So we debit the inventory write-down with 18,171 and credit the inventory account with the same. Right, is everyone clear on that? Yep. Okay. All right, so this is the exercise that we're going to go through next time, which looks at Armstrong flooring. So we've got the year-end accounts for 2014, 15 and 16. So we've got the accounts based on LIFO, and we can see that the figures that we've or have been reported there in the financial statements. So what does the question ask us to do? It says it's a leading global producer of flooring products in the US. Well, obviously you would have guessed that because you're only allowed to use LIFO in certain countries, and as I said, the US is one of them. And then we have extracts of their flooring consolidated statements. The inventories are valued at the lower of cost and market. During the fourth quarter of 2016, they changed their method of accounting from LIFO to FIFO. So clearly, when a company does that, the accounting standard, whether it's in the US or Australia or some other country, they're pretty much the same. You have to show the nature of the change, the effect of the change, and the reason for the change. So you can see what they've done there. They've shown the amount that's being computed under LIFO, what was reported, and what's going to be the effect of the change between FIFO and LIFO. Right, you can see the impact on the bottom line. But you also need to show the prior period, right? So you need to show the adjusted figures for the previous year so the users get a comparison. So they've done the same for the 2015 year. All right, and it says there we use the LIFO method for accounting for our US resilient flooring segment inventories, but we believe the FIFO method of accounting is preferable for the wood flooring segment, considering the volatility of lumber prices and the long production cycle time. Okay, so that's what they've noted in their financial statements. And it says that we want you to attempt this question and see how you go. What you're required to do is to say, why is the assumption prohibited in countries including Australia? Why is LIFOing prohibited? Well, I did mention that at the start of the class. All right, so if you listened to the recording or you remember what I said, you'll be able to write that down. What is the reason why it's prohibited in countries, including Australia, and many others that have joined the international accounting standards. And here we have the effect on the balance sheet. Right, you can see the effect on the inventories because of this change for the 2016 and the 2015 year. Right, and the second thing that we want you to have a think about is from a financial reporting perspective, what are the reasons driving Armstrong Flooring to switch from LIFO to FIFO? Right, what would be some of the things that the directors or the board would have come up with in deciding to switch? I mean, they mentioned there about the volatility of the price of timber, but how does that translate into financial reporting perspectives? Okay, so that's your task for next time, as well as these questions here. All right, so we're going to go through the past exam questions next time. There's 4 of them there, and you can get them from the cloud, as well as the exercises from your book there's a couple of discussion questions as well as 3 problems and a case study. All right, so that's what we'll discuss at the beginning of next week's class. And the topic for discussion next time is going to be non-current assets. Chapter 10 of your books if you want to do a bit of pre-reading. Okay, any questions before we close? No? All good? Okay, wonderful. Okay, I'm going to have a busy time this week because I'm going to be marking your assignments that you handed in. I'm going to try and start them tonight, although I'm not sure how many I'll get done tonight, but I'll certainly make inroads tomorrow and Friday, and I hope to return them to you, well, they say 15 working days, but I'll try and better that. I'll try and get them to you within 2 weeks, all right? But see how I go, because obviously there's a lot of them to get through, and yeah, I'm not going to make any promises, but I'll just do my best to get them back to you as soon as possible. Okay, thanks folks, and we'll see you all next time. Yes, buddy. Sorry?
I need not worry about the assignment, my mistake.
No, it's all taken care of. I will take care of it and you don't have to worry anymore.
Yeah.
All right? All good. Thank you.